We open today's deep dive with a metal that has quietly been losing ground all week, gold. Futures are down 1.46% this session, trading at $4,162.40, and that is not an isolated move. This marks gold's third consecutive weekly decline, a streak that tells you something important is shifting beneath the surface. What makes today particularly striking is that geopolitical conditions would normally be a tailwind. Iran nuclear negotiations are ongoing, and a truce cheer is in the air. Yet gold is still selling off, and that gap between expected behavior and actual price action is exactly where the real story lives. Here is the core fact. Federal Reserve speakers this week doubled down on no-cut guidance through 2026, explicitly contradicting any residual hopes the market had for rate relief. The 10-year Treasury yield is sitting at 4.45% this morning, and that level is doing real damage to non-yielding assets like gold. Market participants had been anchored to the idea that $4,200 would hold as a floor, supported by geopolitical risk premium from the Iran situation. That floor has now been broken. Silver is confirming the weakness, showing a sharper percentage decline than gold itself, which often signals broad precious metals capitulation rather than just a gold-specific move. The deeper mechanism here is the competition between two completely different forces bidding for gold's price. On one side, you have geopolitical risk premium, the Iran truce narrative that would historically drive flight to safety buying. On the other, you have real interest rates, which rise when the Fed holds nominal rates high while inflation expectations remain anchored. Real rates are the structural enemy of gold because they represent the opportunity cost of holding a non-yielding asset. Right now, with the 10-year at 4.45%, that opportunity cost is significant. What this week proved is that the Fed's hawkish signal is winning the tug-of-war decisively, and that repricing is still not fully complete. The direct casualties are obvious. GC equals F and shoulder innovations equals F are the frontline hits. But the transmission is broader. Long-term treasuries, the long-duration treasury ETF, faces pressure when yields stay elevated, so bond bulls are squeezed from the same hawkish driver. DBC, the broad commodity index, gets a deflationary signal from metals weakness. On the equity side, precious metals miners tied to gold and silver are underperforming. Interestingly, the Nasdaq 100 is performing well. The Nasdaq 100 is catching a bid, but that resilience is fragile if yields spike further. The energy sector and energy are roughly flat, getting a geopolitical premium from the Iran situation. Financials like JP Morgan and Bank of America are the structural winners in a higher-for-longer regime. The most important technical level to monitor is $4,100 in gold. That is the next meaningful support below today's $4,162.40 print. And a break there would likely trigger systematic selling from trend-following funds. On the upside, $4,200 is now firm resistance, the former floor that has flipped to a ceiling. In rates, watch the 10-year at 4.45%. Any Fed speaker this week who signals holding beyond current expectations would accelerate gold's decline and compress long-term treasuries further. The VIX is at 16.86, up 2.8% today, showing a modest fear pickup. If it clears 18.00, equity hedging demand could paradoxically bring some safe haven flows back to gold. The Iran truce timeline is the wild card. Any fracture in those talks would spike geopolitical premium sharply above $4,200. The actionable takeaway is clear. Do not fight the macro regime. Hawkish Fed messaging is now the single dominant driver of gold pricing, outweighing geopolitical risk premium that would historically hold the metal firm. Tactical shorts near $4,200 resistance makes sense in this environment, while a break of $4,100 support opens room for further downside. The one exception worth protecting against is an Iran truce fracture. That event would invalidate the trade quickly and sharply, so maintain a defensive equity hedge as insurance. Financials benefit, long-duration bonds stay under pressure, and precious metals miners remain the sector to underweight. That is the full picture on gold this week. Coming up next, a story with major implications for a completely different corner of the market. Shifting now from domestic markets to a developing geopolitical flashpoint that every macro trader needs to have on their radar this morning. Diplomatic talks between the United States and Iran, held in Switzerland and widely watched as a potential path toward a Middle East accord, failed to proceed as scheduled overnight. The breakdown was not a minor procedural delay. Analysts are now projecting a materially longer resolution timeline, moving the horizon from months to quarters or potentially much longer. That shift in diplomatic momentum is beginning to reprice risk premia across energy, precious metals, and volatility markets in real time right now. Here is exactly what we know. U.S. Iran negotiations, mediated through Switzerland as a neutral diplomatic channel, did not advance as planned. No specific accord terms were formally tabled, which means this is not a quantifiable miss against a consensus target. It is a qualitative deterioration in diplomatic momentum that markets now have to absorb and reprice. Wall Street had assigned only a modest probability to a near-term breakthrough by 2026, and consensus was already skeptical, but traders were monitoring closely for a downside surprise precisely like this one. That cautious positioning is now being validated, and the repricing is just beginning to flow through asset classes. The macro transmission mechanism here is straightforward but consequential. When a geopolitical resolution timeline extends from months to quarters or longer, risk premia embedded in energy and safe haven assets do not simply pause, they compound. The Iran nuclear and sanctions backdrop directly influences global oil supply expectations, and any scenario where diplomatic progress stalls removes a potential bearish catalyst for crude prices. Simultaneously, elevated Middle East tension historically redirects institutional capital toward gold, long-duration treasuries, and volatility hedges. With the 10-year treasury yield sitting at 4.45% and the VIX already elevated at 16.86, up 2.8% on the session, the conditions for a sustained geopolitical risk premium are very much in place today. Let's walk through the specific exposure map. WNT offshore crude at 75.66 is actually under pressure from broader macro headwinds today, but the diplomatic breakdown removes a ceiling and supports the bull case for energy. Brent is holding firm. Gold futures are off on the session, but a reclaim of the 4,200 level would confirm safe haven demand is reasserting itself. Watch that level closely. The VIX at 16.86 is elevated but not in crisis territory. Defense names like Lockheed Martin, ticker Lockheed Martin, along with RTX and Northrop Grumman, may see initial support, though expect profit-taking if broader markets stabilize and the situation does not actively escalate further. Here are the specific levels and catalysts you should have on your screen right now. First, the VIX at 16.86 needs to be watched for a push above 18. That level historically marks the threshold where institutional hedging accelerates and risk-off becomes self-reinforcing. Second, gold needs to reclaim 4,200 to confirm that safe haven demand is structurally returning rather than just noise. Third, WNT offshore crude at 75.66 is your geopolitical barometer. Watch for a sustained move toward elevated levels as a signal that energy markets are pricing genuine escalation risk. On the equity side, small caps face headwinds from higher energy input costs if this overhang persists. The bottom line is this: the collapse of Swiss-mediated U.S. Iran talks is not a one-day headline. It is a medium-term geopolitical overhang that structurally supports crude oil, gold, and long-duration treasuries, while introducing a meaningful headwind for growth equities and energy cost-sensitive small caps. Position your defensive hedge ratios accordingly. Keep the VIX and long-term treasuries at the top of your watch list for early signals of risk-off intensification, and do not mistake today's tech resilience for immunity to a sharper geopolitical shock. Those are the two stories that matter most this Friday. Full breakdown is up now. If this kind of deep dive analysis helps you trade smarter, hit subscribe and turn on the notification bell so you never miss a daily market recap. We break down the stories that actually move markets every single trading day.